problem, as I said, is very similar to the case study that's due in a couple weeks. And it's the kind of a problem where you might be called upon to model a project in a situation, and rather than do a base case and a 15% increase in cost or a 15% decrease in benefits, you can do a more nuanced analysis using Monte Carlo techniques. And really what we're getting into now is the concept of value at risk. I tried to introduce that earlier when I was talking about some of the issues with the news vendor model when we were doing Walton Bookstore. But now we're actually going to calculate a value at risk for a particular project. And so this is problem 11.5, which, let's see, that's on page, I got bumped out of my electronic textbook here. Hang on a sec. So 11.5 is on page 643 maybe. And the basic idea here is as follows. You've got a project here that is going to cost a lot of money. It says fixed development cost of, if I'm reading that correctly, $700 million. And rather than trying to estimate revenues, uh, basically we're looking at contribution. Now, contribution is another way of saying margin per unit. So we've got basically, starting in year one, we expect to have a margin of about $4,000 per vehicle. We expect, as the model ages, that its contribution will decrease by 4% a year. And we're given tax rates and a weighted average cost of capital here. We're also told that our sales has a distribution that we're going to use a triangular distribution for. Now, remember last week when we talked about selecting probability distribution? One of the things we said, if you didn't have data, that sometimes a triangular distribution was appropriate because you could select a minimum, a most likely, and a maximum. So this is one of those situations where we have a minimum, a most likely, and a maximum. And if I went ahead and tried to create range names, I would probably get, oh, it worked, okay. And I'm going to go ahead and create range names over here as well. All right. And these decays, I'm just going to leave them like they are because I can model them just fine. All right. So notice that the way this financial model is laid out, it's the end of each year. All right. That means that the fixed development costs are going to come out of the cash flows that we calculate on a yearly basis. And see, that's what we're trying to do right here is calculate our cash flows. So how do we calculate the cash flow for a project? Well, we need to know the revenues, we need to know the costs, right? And we need to know how those are changing. So in this case, we've got a few numbers that we have been given. We also have to keep in mind that we've got a depreciation value, right? So we're going to recognize the cost of development as part of our depreciation. But then what's going to happen on the cash flow basis? We got to add that depreciation back, right? Because we've already incurred the cost. So we want to keep that in mind. All right, so let's start off very simply. What is the unit sales that we expect to get in the first year. How would I model the unit sales for the first year? Risk trying, right? And I would use minimum, most likely, and maximum. So there's my first year sales. And I'm just going to put in some punctuation to make it easy. How about that? You really care? I don't really care that we've got decimal points there. I'm just going to get rid of them by just doing it that way. Okay. Unit contribution is the value that I get for year one, right? And basically what I need to know now is my revenue minus my variable cost. Well, that's my contribution per unit, okay? Now you'll see why we're doing it this way in a second, if it doesn't quite make sense just yet. But my revenue minus my variable cost is going to be equal to basically my unit sales times my contribution, okay? Wow, it's a big number, huh? Now, how do I model depreciation in this example? Well, it says the company will depreciate its development cost on a straight line basis over the lifetime of the car. And we're expecting this model to have a 5-year lifetime, or at least that's how we're going to amortize the fixed cost. So even though I don't like to do it this way, I'm going to say my fixed cost of development divided by 5, right? So there's a magic number in the formula, but you know where it came from. So our before tax profit then is going to equal to our revenue minus variable cost minus our depreciation. So there's our before tax profit. And our after tax profit then is going to equal to our before tax profit times what? Yeah, 1 minus the tax rate. And then our cash flow, as we have discussed already, is going to be equal to our after-tax profit plus our depreciation. Okay. I'm going to get rid of the decimal points here just to make everything the same units. Okay. All right, so is this correct? Here's our unit sales, our contribution. So here's basically the margin minus depreciation gives us before tax, minus taxes gives us after tax, and there's our cash flow. Okay. Now, a couple things are going on here. Let's look at the contribution first of all. We have given to us an annual decrease in contribution. So whatever the contribution was in year one, it's going to be 1 minus that decrease in year two, right? So I'm going to model that by taking my year one contribution times 1 minus the decrease. So that's basically 96% of 4,000, right? And since I've modeled it this way, I can do it all the way across now. And if I hit F9, you will see that the numbers do in fact decrease by 4% every year. Now, how am I going to model sales? Well, I'm told that my sales decay, but they don't decay uniformly like my margin does. My contribution margin decreases 4% year in and year out. My sales, on the other hand, are decreasing by, well, we don't know. It's given a range of values between 5% and 10%, and that range is triangularly distributed. So how should we model that? Any ideas? Well, here is something, we haven't really talked this much about it, but let me introduce you to a concept called autoregression. We normally think in terms, well, demand is normally distributed. And, you know, for academic purposes, that's an easy assumption to make. Everybody knows what the normal distribution looks like, yada, yada, yada. But here's the thing. Remember the normal distribution, you've got a 50-50 chance of being on either side of the mean, right? And it's not really appropriate. Let's say that you say the demand at time 1 is maybe 2 standard deviations below the mean, and time 2 is 2 standard deviations above the mean. Well, that's a pretty big change. And then time 3 maybe is 1 standard deviation below. That could happen with a normal distribution. So your demand could be really, really noisy, right? What we observe in reality, though, is that demand is influenced by the prior period demand. In other words, if demand was above the mean at time 1, then yes, random error says it could be below the mean, but it's still going to have some influence from whatever the demand was in the prior period. This is called autoregressive demand. And that's kind of what we're looking at here. What we're saying is demand in year 2 is going to be a function of demand in year 1. And demand in year 3 is going to be a function of demand in year 2. What we want to model is the decay. So the way I would model this would be exactly the same way I modeled the margin. I would say demand in year 2 is equal to demand in year 1 times 1 minus, and now instead of having a fixed value, it's going to be a value that's triangularly distributed. So I would say risk triang, 5%, 8%, oops, 8%, 8%, and 10%. Because if I do it this way, now demand in year 2 is a function of demand in year 1. It's just that it's been randomly decayed according to that particular formula. Now I need to make all of these absolute references if I want to copy that across, don't I? Okay, so there's demand in year 2, and then demand in year 3, 4, 5. And if I hit F9, you'll see in fact now demand is decreasing across the 5 years, but it's decreasing in a random fashion around that triangular distribution. If I had just done risk triang, I would have an equal likelihood of having demand in year 5 equal to or greater than demand in year 1. And that's not what I want. Make sense? You see where the logic is being used here? All right. So I can just copy this formula across, can I not? And I know I can copy the depreciation formula across. So my before tax profit, well, that's just, I can copy that across. my after-tax profit, since I've got the tax rate as a named cell, I can just copy that across. And then finally my cash flow, I can copy that across. So everything else is just a repeat, right? So keep in mind now I haven't hit F9 yet, so I don't have all these numbers. I've just basically copied the same numbers. I haven't changed them yet. What about the net present value of my cash flows? Well, I've got my cash flow at the end of every year, don't I? So those periodic cash flows, I can use the NPV formula to calculate, right? So I can take equals to NPV of, well, first of all, it wants the rate. Well, the rate is the discount rate. Do I need to divide that by anything? Multiply it by anything? Probably not. 10% looks like an annual rate, doesn't it? So I'll just keep it like that. And then take all these cash flows across here. And I'm done, right? I have to recognize my initial cost. And my initial cost is the fixed development cost. Okay. So now I'm going to go to at risk and do just two more things. I'm going to define an output value for an NPV of cash flows. And now I can run my simulation. So let me do that. And there's my answer. Okay, so let us now, and I haven't been emphasizing this enough, I don't think. Just running the simulation or doing the calculation, that's not really what you're going to get paid for as a business modeling person or an analyst or in whatever position you're in your organization. You're going to be paid for actually analyzing the results and making meaningful observations to the managers or the executives or whoever it is that's making the decision. So let's try to make some meaningful observations about this. So the first observation that we want to make is that these cash flows look, well, they look triangular, don't they? See how it comes up and then comes down? Now, those are frequencies, but should that be of a surprise to us? No, we use triangular random variates, so I'm not surprised that the cash flows came out that way too. What I note is that the mean net present value of this project is positive, $31,500,000 at a 10% discount rate. So the question is, first of all, should you undertake this project? Well, positive net present value argues yes, that you should undertake this project, assuming you have $700 million that you can invest. But now let's look at this 5% number. That 5% number is the so-called value at risk. It tells you low probability, but what is the likelihood that this project, what's your likelihood of experiencing a loss on this project? Well, at 5%, your loss is roughly, and these values are in millions, so your loss is roughly $68 million. In other words, your value at risk is $68 million. You could lose as much as $68 million on this project if everything went south. How do decision makers use that information? Because you could say, well, all right, what is your break-even value? Maybe that's something we should look at. So let's look at our break-even value. All right, so we have got roughly a 61.6%, excuse me, 71.6% probability that we would break even or do better, right? We've got a 28.4% probability that we'll not break even. But what does break even imply here? Does it imply we lose money on the project? Is that what break even means? No, what does break even mean? It means our return on the project is exactly equal to our weighted average cost of capital, right? A net present value of 0 means your discounted cash flow at 10% is the same as if you took that money and put it in the bank at 10%. Right? So when you see a net present value of 0, it does not imply break even. It just means that you're earning exactly the rate of return that you need to justify the investment. What that also means then is that if you have, in this case, put this back at 5%, if you have a value at risk of negative 68 million, that does not mean you're actually going to lose $68 million, right? It just means that your return on this project is less than your required return to the tune of $68 million. But it doesn't mean you're losing money. Now, given that nuance, what decision would a decision maker make? Well, here's the way it works in the real world. All companies have some level of risk tolerance, right? The reason they're in business is to take risks and generate a rate of return for their shareholders in excess of what the shareholders could get with another investment of a similar risk profile. And this should all be clear to you from finance, right? Think of the efficient frontier and the capital asset pricing, all that stuff. All right, so here's the deal. If I'm an executive, I've got a risk profile in my mind that I realize I'm not going to make money on every project I undertake. I'm not. Hopefully, every project I undertake is going to make my shareholders better off. But if all I do is invest in projects that are guaranteed to make, shareholders better off, then I'm not taking enough risks. I'm not doing anybody any favors here. So I have a risk profile in my mind that says I'm willing to undertake certain projects that have a profile, and I'm going to call that the value at risk. I'm going to come up with a number for a value at risk. And maybe that number is 10 million, maybe that number is 100 million. If you're looking at some of the exploration and production companies that are going out and exploring for oil, and you hear these huge numbers about, they're spending $100 million and they could come up with a dry hole, right? But that's the risk profile that they're undertaking. So they look at that value at risk number and they say, okay, what is my value at risk? And if this project is better than that value at risk number, I undertake it. So in this case, I'm an automobile company. Maybe my value at risk is minus 100. I am willing to undertake a project that, number one, has a positive net present value. That's the first thing, right? This one has a mean positive net present value of $31 million. So yes, I've got confidence, in as much as my estimates are correct, that this project will create value for my shareholders above and beyond the required rate of return. But I also know there's a probability that my estimates are not perfect. I can't know the future with clarity. We're going out 5 years. What happens if we have another financial crisis in 5 years? Am I really going to sell that many cars? I don't know. Do I want a model for that? No. I'm going to pick a value at risk number that says I'm willing to tolerate this level of risk. And that's what that 5% number identifies for you. This is your value at risk. It's the amount of risk that you're willing to undertake. This is a very, very important concept. Probably more so in corporate finance than in, well, it's obviously corporate finance, but it's probably more so in companies that are very capital intensive and have to take on large capital projects that entail a large amount of risk. So you would see that in, like I said, E&P companies and things like that. Questions? Everybody's clear on the concept that a negative net present value does not mean you lose money, right? We don't know, but that negative 67 could still be a 1% payout or something like that, right? Okay. So here's the deal. You now have enough understanding of financial modeling and value at risk to do the case study.